Welcome to the February 2026 edition of Let's Talk Markets. As always, our goal is to educate, inform, and empower the families and businesses we serve. So, if you find today's discussion valuable, we encourage you to share it with others who might benefit from staying connected to what's happening in the markets and also why it matters. But this month, we're going to start by looking at how markets have begun 2026 and what January's early signals they might be telling us. Then we're going to zoom in on what the market is most focused on right now, what's driving volatility, and the big questions investors are asking around AI. And then we're going to close with something kind of fun. We're going to examine how Valentine's Day relates to the markets. We've got a great show for you, so let's get to it. And so to start off, we're going to talk a little bit about why January really matters in the market. Does it? Well, this past January, the S&P 500 finished up 1.4%. And while that may not sound dramatic, history suggests that how a year starts can have an outside effect on the remainder of that year. And so there's a long-standing concept in the markets often referred to as the January barometer. The idea that how markets start the year can influence how that year unfolds. And so you may have heard the phrase, an object in motion tends to stay in motion, unless acted upon by an external force. Well, markets, they're not physics, but the analogy actually fits pretty well in this case. And so how has this played out historically? Take a look at this chart. Kind of the sweet spot of January. The chart isolates years going back to 1950, where January finished up between 0 and 2%. That's exactly where we landed this year. And here's what's interesting. When January posts a return in that 0 to 2% range, the market finished higher over the next 11 months. You ready for this? 92% of the time. And the average forward returns were meaningfully stronger than a typical year. So as you can see here, it's pretty interesting when you look at what those actual return numbers have been and looking at the average return. And you can see that 12% was that average return when you started the year off of that 0 to 2% in January versus all the other years, as you can see on the bottom, 8.2%. Pretty meaningful. Now, what about February? This second chart, it shows the average monthly returns for the S&P 500 going back to 1950. One thing kind of stands out, and it's pretty clear. Over the past 20 years, even over the past 10 years, and even during midterm election years, which we are now, February, along with September, have historically been one of the weakest months for the market. And that's across multiple time frames. February's average return, it's lagged, earning its reputation as what some investors call a banana peel month. So what's the takeaway here? The context helps separate normal volatility from real risk, right? A strong start in January has historically signaled good things for the rest of the year, 92% of the time, right? And February weakness is normal. And it reminds us that markets rarely move in straight lines. So this month, Ryan's market fact, pretty interesting one here. Walmart joins the $1 trillion club. So it highlights, as you can see here, how much market leadership has so much evolved. Walmart recently joined the $1 trillion market cap club. And it becomes only one of a handful of U.S. companies to ever reach that level. And notably, it's just the third non-tech firm to do so. And you can see that. The other two tech firms here, or non-tech firms, here at the bottom of the screen. What's driving it? That's what's important. Walmart has seen meaningful growth from e-commerce, digital advertising, and increasingly AI-enabled partnerships that are improving logistics, inventory management, and customer engagement. And so in other words, Walmart isn't nearly as offline as its reputation might suggest. I don't know about y'all, this is where we get groceries from. Walmart Plus makes it easy. We We just get a shipment from Walmart to our front door. And from an investor perspective, it's a good reminder that market leadership doesn't always come from where you expect it. Some of the biggest beneficiaries of technological change aren't pure play tech companies. They're firms that know how to scale, adapt, and execute. I think that's something important as we go forward into this new AI world, right? It's the theme of selective leadership is going to matter a lot, especially as we move through 2026. So let's take a look at where the market has been just in this very short period of time to start 2026. Very interesting when you look at the numbers, right? The S&P 500, as you can see, we talked a little bit about, pretty strong start to the year, even with what we've seen over the course of February, still up about 1.3%. But there's a pretty significant difference, and you're starting to see that parity between the S&P 500, which is that market cap weighted more towards the tech side of things, and that Magnificent Seven, like we've talked about, to like the Dow Jones. Dow Jones is up 4.3%. Interesting to finally see that change. The NASDAQ, believe it or not, obviously the NASDAQ focused more on the tech side of things, actually negative for the year, almost negative 1%. You're finally starting to see the outperformance, though, of small mid-cap stocks. The Russell 2000 up 7.6%. Even foreign stocks. International stocks up 5.7%, emerging markets up 7.3%. Finally, you're seeing that value and growth change too, especially within the Russell 2000, the Russell 1000, where growth is actually negative for the year, growth stocks in the Russell 1000 at negative 3%, and the Russell value actually up 6%. So pretty significant difference, and different than what we've seen in the last 3 years of the market. This is fascinating. The top 3 sectors for this year, right, in just the last 6 weeks of the market, energy is leading the way. Believe it or not, up 19% to start 2026. Consumer staples up 14%. Materials up 12%. What about the worst performing sectors? Tech down 3% for the year. Consumer discretionary down about 3%. And financials down less than 1%, the worst 3. So interesting to see finally that change, that the bottom 3 to start this year had really been the top 3 over the course of the last couple of years. Then you look at kind of where we stand in terms of unemployment, around 4.4%, but we're finally seeing that inflation, that core CPI, 2.6%, getting closer and closer to the Fed funds target of that 2%, or what the Fed wants the inflation rate to be, around 2%. So kind of interesting, obviously only 6 weeks into 2026, but some pretty significant differences from what you're seeing in the market right now. Now, kind of our big discussion, what is the market telling us right now? And as we start a new year, it's always worth pausing, especially after the run that we've seen, and one run we've had in 2023, strong year, 2024, another strong year. 2025 followed suit, right? 3 strong years in a row. It's not something to ignore, and it naturally sets the stage for the question investors are finally asking now. What could kind of disrupt this trend? And lately, I've heard a lot of the same questions come up over and over again. It's what you hear on the TV. And that question is there an AI bubble looming? Has the hype around AI and artificial intelligence gone finally too far? And these are fair questions. And today, I want to clear that up. I understand how this can get confusing, right? Because the headlines, they tend to blur these lines. But there's an important distinction between what the market is actually focused on and what the headlines may lead you to believe. The market, it's not debating whether AI will be real and valuable or productive over the long term. That part really isn't the question. What the market is really scrutinizing here, and what's driving some of the volatility you may have noticed recently, is how much money the largest technology companies are spending to build out AI infrastructure. Because it's staggering, and we talked a little bit about that in previous Let's Talk Markets. It's a very practical discussion. How much is being spent? How fast is it being spent? And when do those investments begin to translate more clearly into earnings and cash flow? Well, why is capital spending at the forefront and the center of this discussion? Let's look at this. Capital expenditures, or capex like we talk about it, are long-term investments in things like data centers, chips, power, networking, and storage. They're large upfront costs designed to support growth over many years. And the scale is significant. Companies like Amazon, Alphabet, Microsoft, Meta, they collectively spent close to, you ready? $400 billion on capital investments just last year alone, obviously largely tied to AI infrastructure. And estimates suggest that number could rise meaningfully again in 2026. You can see it here on the chart. It's a broad, industry-wide acceleration. That's why this keeps showing up in the headlines and the earnings reactions. The spending is real, and it's accelerating. So here's a logical way to think about it, right? If you're building a house, you plan to live in it for the next 30 years, you say. Are you going to cheap out on the foundation? You spend up front to make sure it's built correctly, so you don't pay for it later. That's how many of these companies are approaching AI. But why is this moving the whole market, right? These companies, they're heavily concentrated in the major indices. We know this. We've talked about this before many times in previous Let's Talk Markets. So when investors get new information about AI spending or returns on that spending, it doesn't just move one stock. It can move the markets at large. And we have seen that here recently. That concentration is exactly why this is being examined so closely right now. That's why you've seen a company like Google. They reported strong earnings results, and still, they got a negative stock reaction because the market may be focused less on what happened last quarter and more on what the spending implies about the next few quarters. And because Google is one of the top 5 largest companies, you saw the market indices fall that day. All right, so what's the big picture? What do we believe at Beavers Wealth Management? I'll tell you, there's a lot of noise right now. You're hearing talk of an AI bubble, right? You're seeing volatility and you're seeing mixed signals. And I think it's important to remember, we're talking about the most innovative, data-driven organizations in the world. To question the pace of spending is reasonable, and we should. But to question whether they believe in the value of what they're building doesn't really make sense. If this infrastructure is meant to support the next decade or more of growth, spending heavily upfront is the logical approach. The driver of volatility isn't whether AI will matter. It's whether companies are being smart and disciplined in how they're going to build it. And we're still in the early stages of how artificial intelligence will be applied across a number of different industries, right? Think about healthcare, logistics, software, and areas we haven't even fully imagined yet. Markets tend to overestimate the impacts of new technologies in the short run and underestimate their significance in the long run. That's an important part to remember. And as clear reminder, as we've said many times on Let's Talk Markets, long-term market growth ultimately comes down to earnings. And what's the other one? Interest rates. Both of which still matter far more than short-term headlines. And so this is exactly why we believe now is a prudent time to take a closer look at how you're invested. When markets are calm and leadership is broad, being passive, they can feel comfortable. But in an environment like this, where concentration is high, quite frankly, the highest we've ever seen, and leadership is narrow and new information is coming out constantly, simply riding the index or staying put gives you no ability to adjust. And we've talked before on our Let's Talk Markets about our second opinion service. And for everything we just discussed around AI and volatility and market concentration, we believe this is one of the most valuable times to use it. It's an opportunity to step back, review your outside accounts, and make sure your portfolio is aligned with today's realities. Because our goal is to confirm that your strategy is disciplined, intentional, and built for what's ahead. We've seen it firsthand, how helpful this perspective has been for our friends, our family, our clients, and we'd be honored to offer that same second outlook for you. So now let's get to our final part of today's conversation. It's going to be fun. It's a little bit about Valentine's Day. Don't forget, it's coming up this weekend. And so one of the things we've talked about on previous Let's Talk Markets before is how seasonality can drive consumer behavior. And if you remember in previous editions of Let's Talk Markets, we've highlighted, remember the pumpkin spice economy? Well, holidays are cyclical as well. And with Valentine's Day coming up, we thought it'd be interesting to look at a few quick numbers behind the holiday and how it ties back to the markets. So I've got 5 interesting ways that Valentine's Day shows up in the economy. First, this is a major discretionary spending event. I didn't realize until we started looking at this, but according to the National Retail Federation, Americans are expected to spend over $29 billion this Valentine's Day, with average spending of about $200 per person, placing it among the highest spending holidays of the year. I was blown away when I found that out. So outside of Christmas, Valentine's Day is the highest spend, even beating out Halloween. I was kind of surprised about that. So that's number one. Number two, a lot of it is small ticket items, but big volume. So the most popular gifts remain candy, cards, flowers. These are low dollar but high volume items, which tend to be margin friendly and meaningful for seasonal retail sales. Third, experiences, they still matter. Nearly 40% of consumers plan an evening out, reinforcing a trend we've continued to watch. Spending on experiences remains resilient. I don't know if I'm going out on Valentine's Day though, because the crowds are insane. You'll have to tell me if you end up braving it. Fourth thing, spending extends well beyond couples. Over half of shoppers plan to buy gifts not just for their significant others, but for family members as well. And are you ready for this? More than a third will buy gifts for pets. Number 5, record spending supports consumer sentiment. This year's record dollar levels of Valentine's Day spending add to the broader picture we've been showing. Consumer discretionary spending remains elevated. Holidays don't move markets on their own, we get it. But economists and investors watch holidays closely because even seemingly small seasonal data points can offer insight into confidence, demand, and where consumer-driven growth may be headed next. All right, well, I ask each of you too, let me know what you end up doing for Valentine's Day. Send me some pictures. I'd be interested to know how you decide to spend your Valentine's and whether you contribute to that $26 billion spend this year. We're so grateful you joined us today, and we encourage you to share this content with anyone who might find it valuable or interesting. And we have all the replays of our Let's Talk Markets posted on our YouTube channel. And if you haven't checked it out yet, you should, because it's also home to our Beaver Nuggets and our podcast Between the Bears and the Bulls. And I got to tell you, we cannot wait to share with you our conversations with some amazing guests that we've already had interviewed this year. So please be on the lookout for our emails announcing the release of those upcoming episodes. And so, as always, if you have any suggestions or feedback or things you want to see from us, just let us know. We want to make sure the content that we continue to invest in and put out to y'all is valuable for each one of you. All right, so last thing I'll leave you with, one thing I've learned over the years you be very careful with your Valentine's Day flowers, okay? Because you know the worst kind that you can give? Cauliflower. We'll see you in March for the next edition of Let's Talk Markets. And don't forget, leave it to Beavers.